Yeah, good afternoon, friends. So, in profit or loss prior to incorporation chapter, we have done first problem in the last class. Now we'll see second problem. Just wait, sir. I'm sharing material. Sir, I'm not getting share, sir. Please allow me to share the document.
Given, sir.
Okay, thank you, sir. Okay, friends. Till now we have discussed how to calculate profit or loss for pre-period and post-period. We have discussed that procedure in detailed manner, and we have done one problem, that is first problem. Okay, next we'll see second problem. Right, see the second problem information. Right, sir. So here ABC Limited was incorporated on 1st May 2014 to take over the business of DEF and company from 1/1/2014. Okay, sir, here the company incorporated on 1st May. So this is the date of incorporation, sir. And the company acquired a existing running business from 1st January 2014. So this is the date of conversion, right? So this is the date of conversion from sole trader business or partners business point of view. And from company business point of view, this can be treated as date of acquisition. Okay, so date of conversion or date of acquisition is 1/1/2014, and the company incorporated, and we got incorporation certificate on 1st May 2014, right? So here 1st January 2014 to 1st May 2014, this period is called as pre-incorporation period, right? Right. Next, from 1st May 2014 onwards, the company continue its business. Okay, so from that day onwards, we call it as post-incorporation period. Okay. Next, the summarized profit and loss account as given by ABC Limited to the year ending 31st December 2014 is as under. Okay. So they have provided summarized profit and loss account, sir. That means the company closed its books of accounts on 31st December 2014, and they prepared trial balance on 31st December 2014. From the trial balance, they have already prepared one summarized consolidated P&L. Okay, so in this summarized P&L, the income and expenses consist total period income and expenses. Total period in the sense pre-incorporation period and post-incorporation period. Okay, so these incomes and expenses consist total period incomes and expenses, sir. Okay, now we have to split these incomes and expenses to pre-period and post-period based on a reasonable basis, right? We have already discussed how to identify the reasonable basis and how to allocate. Okay, right. So once I explain the procedure, okay, I explain the entire items how to allocate. Then we'll see the solution. Okay, right. See, first gross profit given, sir. So gross profit given directly, we don't need to calculate. Okay. Otherwise, if it is given like sales separately, cost of goods sold, purchases, opening stock, closing stock, if it is given separately, then we have to calculate gross profit separately in a separate working note. Okay. Then we allocate that total gross profit to pre-period and post-period. Okay. Here we don't need to calculate, sir. That is given in the problem directly. Okay, right. So we can allocate this gross profit based on sales ratio to pre-period and post-period. Right. Next item, other income. The other income consists interest on investments. Okay, that is 36,000. So we can allocate this interest on investment to pre-period and post-period based on time. Okay, here interest, sir, this is time-based income. Okay, interest expenditure also accrue based on time, as well as interest income also accrue based on time. Okay, both can be allocated on time basis. Okay, but if any additional information given for this interest, we have to consider that additional information also while allocating. Okay, so we have to consider additional information also while allocating, right? Okay, next, finance cost. Okay, so under expenses, first expenditure is finance cost. That finance cost consists interest on debenture, sir. We already discussed how to allocate this interest on debenture. Okay, sir, it belongs to exclusively post incorporation period, right? So in the basic process only I explained, okay, that company issue debentures after its incorporation. Okay, company can only issue debentures after its incorporation, and after issue of debenture only the company pay interest on these debentures. Okay, so the whatever the interest on debenture given, that entire interest belongs to post incorporation period only. We have to charge to post incorporation period only, right? So this is exclusive post incorporation expenditure. We have already discussed it, sir. Next, under employee benefit expenses, salaries including manager salary given, sir. So total salaries are 3,31,000. The 3,31,000 includes 85,000 for manager salary, right? So this is as it is salary, that accrue based on time. Okay, we can allocate based on time ratio, but we have to consider additional information also. Okay, while allocating, we have to consider additional information. Okay, if any other criteria specified in additional information, we have to consider that additional information. Okay, right. Next, rent and taxes. So rent and taxes are time related expenditure. We can allocate based on time ratio. Carriage outwards. So this is carriage outwards related to sales. Right? We already discussed it, sir. Carriage outwards incurred based on sales. Carriage inwards incurred based on purchases. Okay, so carriage outwards can be allocated based on sales ratio. If it is carriage inwards, we can allocate based on purchases ratio, right? Next, printing and stationery. So that can be allocated based on sales ratio. Sorry, time ratio, sir. Printing and stationery can be allocated based on time ratio. Next, sales commission. So it is purely sales based expenditure, sir. So it is purely a sales based expenditure. We can allocate based on sales ratio. Next, bad debts. Bad debts related to sales, it is given, sir. Okay, unless otherwise specified, we can allocate bad debts based on sales ratio. Okay, but if any in additional information, if any other criteria is specified, we have to allocate based on that other criteria. Next, underwriting commission. So this is underwriting commission paid by the company for issue of shares. Okay, so it is a share issue expenditure, sir. Okay, so that it is related to purely company. Okay, so underwriting process. Okay, so at the time of public issue, when company goes for public issue, the company may appoint underwriters. Okay, for assurance of full subscription. Okay, so that underwriter guarantee full subscription. Okay, for that purpose, the as a consideration, the company may pay some commission, that is underwriting commission. Okay, so it is a part of share issue expenditure, right? So as it belongs to company, we should charge only to company period. Okay, underwriting commission, it is exclusively post incorporation expenditure. We should charge only to post period. Next, preliminary expenses. Okay, we already discussed it, sir. Generally, preliminary expenditure incurred before incorporation, but it belongs to company. Okay, company formation expenditure. So we should charge to company period. We should charge to post incorporation period only, right? Next, audit fees. Sir, here in this table, it is not clearly specified. Okay, whether this audit fees is statutory audit fees or tax audit fees, it is not specified here. Okay, we consider additional information. Okay, so they may give clarity in additional information, sir. Suppose if additional information is also silent. Okay, if nothing is specified in additional information, whether it is audit statutory audit fees or tax audit fees, then we can take an assumption. Okay, we can take a reasonable assumption and we can allocate based on that assumption. but you need to write that assumption in notes. Okay, so whenever clear information is not there in the problem, okay, if information is not clear anywhere, okay, you can take reasonable assumption, but you need to note that assumption in your answer. Okay. Right. Next, loss on sale of investment given, sir. Sir, here loss on sale of investment, it is not a period based loss, right? It is not a time based loss, and it is not a sales based loss, sir. Okay. So while allocating, generally we consider basis. Okay. If it is time based expenditure, we allocate based on time ratio. If it is sales based expenditure, we allocate based on sales ratio. Right. But it is not time based loss, it is not sales based loss. Okay. So this is particular event based loss, sir. Okay. Whenever we sell investment, at that point of time, the profit or loss may arise. Right. So here we have to consider additional information to allocate this loss on sale of investment. Okay, they'll provide some basis, they'll provide some information. Okay, so based on that information, you have to allocate this loss. Suppose if investments were sold in pre-period, okay, if entire investments were sold in pre-period, then we should allocate this entire loss on sale of investment to pre-period only. Okay, if the investments were sold in post-period, if they sell the investments in post-period, then we should charge entire loss to post-period only, sir. Okay, so it is event based loss. We should charge to that particular period. Okay, in which period the investments were sold, we have to allocate loss to that particular period only. Right. Okay, that's it, sir. Total expense given, then they calculated combined profit or loss, total profit or loss. Okay, so we split this profit or loss into pre-period and post-period. Okay. Right. Now see additional information. Prepare a statement showing allocation of expenses and calculation of pre-incorporation and post-incorporation profits after considering the following information. So this is the requirement of the problem, sir. Okay, here we have to prepare statement showing pre-period profits and post-period profits. Okay, some additional information given. We'll see the additional information. Okay, so in additional information, see first point, GP ratio was constant throughout the year. So what it means? GP ratio was constant throughout the year means the gross profit margin is same in pre-period and post-period. Okay, so their gross profit margin is same in pre-period and post-period. Okay, so here I'll tell you one pointer. Try to remember, when gross profit margin is same in pre-period and post-period, then only we can allocate total gross profit based on sales ratio. Okay, so when gross profit margin is not same in pre-period and post-period, okay, when there is a change in GP margin in pre-period and post-period, then we cannot allocate total gross profit to pre-period and post-period based on sales ratio. Okay, so try to understand, when GP margin is same throughout the period, then only we can allocate total gross profit based on sales ratio. Okay, the reason I will tell you later in further problem. Okay, why we should do like that? The reason I will tell you, I'll explain with example figures in further class, sir. Okay, but just try to remember this point. Okay, when GP margin is same throughout the period, then only the sales proportionates and cost of goods sold proportionate and gross profit proportionates will be same. Okay, otherwise when there is a change in GP margin, sir, when there is a change in GP margin, when there is a change in either selling price per unit or cost price per unit, okay, then there will be a change in GP margin. Right. So when there is a change in GP margin, then the sales proportionates and cost of goods sold proportionate and gross profits proportionates will be in a different manner. Okay, Just try to this pointer, try to remember this pointer. Okay, I'll explain with example with the reason in the next class in further problems. Okay, so here as the GP margin is same throughout the period, we can allocate total gross profit based on sales ratio. Okay, so there is there is, it is clear, sir. We can allocate the total gross profit based on sales ratio. Okay, next, see second point. Sales for January and October were 1.5 times the average monthly sales, while the sales for December were twice the average monthly sales. Okay, concentrate here, sir. Here, monthly average sales relation given, sir. In this problem, monthly average sales relation given. Okay, but in the first problem, they provided amount of sales for different periods. Okay, they provided amount of sales in pre-period and post-period. Based on that amount of sales, we have calculated sales proportionate, sales ratio for pre-period and post-period. Okay, but here to calculate sales ratio, the amount of sales were not given, sir. How much value of sales are there in pre-period, how much value of sales are there in post-period, that information is not given. Okay, so here they are saying the relation, monthly average sales relation given. Okay, based on this relation, we have to calculate sales ratio, we have to calculate sales proportionate. Okay, so we'll see in working how to calculate sales ratio. Okay, next, bad debts are shown after adjusting a recovery of bad debts, recovery of 7,000 of bad debts for a sale made in July 2011. Okay, so this is the additional information relating to bad debts. While allocating bad debts, we have to consider this information. Okay, so we'll discuss in a detailed manner while discussing a working note. Okay, next, manager salary was increased by 2,000 per month from 1/5/2000 onwards. Okay, see here, this information relating to manager salary. Here, manager salary increased from 1st May 2014 onwards. Okay, so understand one point. Sir, here manager salary increased. That means every month manager salary was not same. Every month salary was not same. Okay, when every month salary was not same, then allocation of total salary based on time ratio is not correct. Okay, you will not get the exact salary accrued in that particular period. Okay, when every month expenditure is same, then we can allocate total expenditure based on time ratio. Okay, then we get exact amount of expenditure incurred in pre-period and post-period. Okay, so when every month expenditure is not same, okay, when there is a change in expenditure in pre-period months and post-period months, okay, then we cannot allocate total expenditure based on simply time ratio. Okay, so we have to allocate in a different manner, right? Okay, how to allocate, we'll see while working notes here, while doing working notes. Next, fifth point. So here all investments were sold in April 2014, right? So this is the information relating to investments. So here it is clearly given all investments were sold in April 2014 itself. That means the whatever the loss we have arised, entire loss arised in the month of April, right? Now we have to see whether the April month is there in pre-period or post-period. Okay, the loss on sale of investment belongs to April month, sir. If the April month is there in pre-period, then we have to charge that loss to pre-period. Okay, if the April month is there in post-period, then we have to charge that loss to post-period, right? Okay, we'll see while allocating. Next, the entire audit fees relates to company. Okay, here it is clearly given, sir. Okay, the audit fees relating to company. Okay, that may be statutory audit fees, sir. Okay, so as it is belongs to company, we have to charge to only post period. Okay, so this is exclusive post incorporation expenditure. Okay, we should charge only to post periods, right? Okay, so this is the additional information, sir. Now we'll see answer, how to present the answer. So first, obtain basic information. Basic information in the sense which is required to allocation of expenditure. Okay, that is time ratio and sales ratio. Okay, first calculate time ratio and sales ratio, sir. Right. So give the heading working notes. So working note number one, calculation of time ratio. Right. So first take the date of conversion and date of incorporation and date of final accounts of company, sir. See here, date of conversion. See here, date of conversion is 1st January 2014, right? So date of conversion is 1st January 2014. Next, date of incorporation, sir. So here the date of incorporation is 1st May 2014. And the date of final accounts of company is 31st December 2014. Okay, sir. So here first pre-incorporation period is 1st January 2014 to 1st May 2014. So this is pre-incorporation period, right? Next, 1st May 2014 to 31st December 2014. So this is post-incorporation period, right? See how many months are there in pre-incorporation period. So January, February, March, April. Okay, 4 months are there in pre-incorporation period, sir. Okay, so pre-period 4 months. See how many months are there in post-incorporation period? May onwards. Okay, so May to December, sir. May month to December month, right? So total 8 months, no? Okay, 8 months are there in post-incorporation period, sir. Now see the time ratio. So time ratio 4 is to 8, right? right? So if you simplify, 1 is to 2. Okay, so this is time ratio, sir, right? So we can allocate all the time related expenditure based on this time ratio. Okay, next, in working note number 2, calculate sales